Welcome to How to Retire on Time, a show that answers your questions about all things retirement, including income, taxes, Social Security, healthcare, and more. This show is an extension of the book, How to Retire on Time, which you can get a free digital copy today by going to www.howtoretireontime.com, or you can grab a physical copy on Amazon. Just search for How to Retire on Time. My name is Mike Decker. I'm the author of the book, How to Retire on Time, but I'm also a licensed financial advisor, insurance agent, and tax professional, which means when it comes to finance, we can pretty much talk about it all. Now, that said, please remember this is just a show. Everything you hear should be considered informational as in not financial advice. If you want personalized financial advice, you can request your wealth analysis from my team today by going to www.yourwealthanalysis.com. With me in the studio today is Mr. David Franson. David, thanks for being here.
Yes, always happy to be here. David's
going to read your questions, and I'm going to do my best to answer them. You can always text your questions in to 913-363-1234. Again, that number, 913-363-1234. Or you can email us at heymike@howtoretireontime.com. Let's begin.
Hey, Mike, what do most people do if they want to retire before full retirement age?
Okay, a little bit of ambiguity in that question.
Yeah, we have to define
what is retirement age.
Yeah, what is retirement age? What is full retirement age?
So there are 3 or 4 different specific regulatory tax law landmarks that I think are important to note. The first one is the rule of 55 and then 59 and a half age. So let me explain that. If the majority of your assets are in an IRA, pre-tax 401k, or a traditional IRA, then you cannot take money out before 59 and a half, or you will receive a 10% penalty. The idea was put money into this account, we'll give you some tax benefits, and we're trying to keep the money in there for retirement. That's why they put that 10% penalty.
Yeah.
They're trying to incentivize you to save for retirement. So most people will wait until 60 years old to retire. Now, the rule of 55 says if you end employment at 55 or later, this is an oversimplified definition, but if you end employment at 55 or older and you keep your assets in your 401k, in most situations, you should be able to pull income out of your 401k and not get hit by the 10% penalty.
How do they do that?
I don't know. It's just the tax code.
Oh, okay.
Yeah. Just how it's written.
All right.
And so I say that because we don't want to just say, well, I'm going to retire at 60 years old because that's when I have access to my money. I mean, time's your most precious commodity.
Mm-hmm.
How much is a year of your life worth? If you could retire at 57 years old and finances were not an issue, would you?
Yeah, I think so.
And then there's other ways around it. You've got 72T, which can help you take income out. 72Q, if you've got a bunch of annuities that you want to take out slowly as well. There's some nuance in other ways. They're really difficult to work with. But those are the simple ones. So if you want to retire before 55 years old or 59 and a half, then make sure you're funding a good amount of your assets in really 2 accounts. So one is your brokerage account. It's after tax. Yeah, you sell it, you're going to pay capital gains on it.
Sure.
Short-term, long-term, whatever it is. But you can do whatever you want with that money. And then the second one is you could consider life insurance. Again, if you're funding life insurance for tax efficiency, you could borrow against the policy and bridge the gap into retirement while still maintaining the death benefit in case you were to pass and help the surviving spouse get through there. Again, I cannot say this emphatically enough. When we talk about life insurance, it's not an investment.
Yeah.
There's cost of insurance. You're paying for a death benefit. It has to make sense. Too many times I see people doing podcasts and writing articles saying that index universal life is the most incredible thing and that's all you need, and forget the 401k, just put your money in here and quote unquote be your own bank.
Oh.
No, please don't fall for these marketing traps. Index universal life can be an effective part of your policy, but just please, there's no such thing as a perfect investment product or strategy. Anytime something seems too good to be true or that you're winning, you're not. You just don't understand either hidden costs or other detriments. But I digress.
They're very smart, the insurance people, right?
No, it's not. Yeah, insurance companies are smart, but it's the agents that sell them have learned how to manipulate people into buying something without explaining the full context of what it is. We need to understand the benefits and detriments of these things. So, and I would say index universal life is probably more complicated than buffered ETF, structured notes, or the more sophisticated investment products on the security side. I mean,
really?
Index universal life is complicated
Yeah.
and often a black box of whatever is the inner workings are. Anyway, so that's the 60 years old and before.
Okay.
Now you might say, well, hey, I can't retire because I need health insurance. I don't want to retire from work.
Oh, right.
Because I need the health insurance.
Big component. Yeah.
Well, if you could afford Affordable Care Act insurance,
Yeah.
you can get a nice policy, a very generous policy. Again, how much is a year of your life worth? I mean, let's say for a couple, let's say you're going to spend $24,000 a year in healthcare from age 60 to 64, then 65, you get Medicare.
Okay.
And you can afford that. Would you rather have 5 extra years of your life to do more of what you want, have higher purpose, less stress?
Yeah.
Maybe you like your job. Maybe you don't need to retire that early, but people they're delaying their retirement because they don't know the efficiencies on how to bridge certain gaps. It's just kind of this out of sight, out of mind. I don't want to think about it. This is what I know. I'm going to stay in this area. A lot of things that could be done there.
Right.
So that's the bridging the gap. And by the way, we do all this stuff in-house. We do the Affordable Care Act shopping in-house.
Yeah.
Quick secret, by the way, on Affordable Care Act insurance and Medicare. There are some policies that are really, really good, but pay a very, very low commission. They're often not recommended. I mean, David, you head up our health insurance.
I do. Yeah, I did.
What was your mandate?
Yeah, the mandate that I was given was we assign the policy that best works for the client. Like whatever fits their needs, that's what we're going to give them, and no other considerations.
We don't care about healthcare insurance.
Yeah, we don't.
It's not our wheelhouse. We just brought it in-house because when we would send it out, people would get the wrong policy. And we knew this, and then we would confront people, and it was just a hassle. So anyway, all right. So that's the 65 and the Medicare. And by the way, when you start Medicare, just as a quick tangent, make sure you get into the right policy that you want at the beginning. It's okay to want original Medicare, traditional Medicare. It's okay to want a supplement plan or a gap plan. It's okay to want Advantage plan. They all offer something completely different. And it's important to understand the benefits and detriments of those different options.
Right.
Because you want to start right. Because if you want to switch later on in life, gap, you can get denied for some of the plans.
There are some caveats to be aware of and some difficulties. But
but that's the first one. And then 67 years old, Social Security. Some people say, I can't retire until I can turn on Social Security, and I don't want to get a discounted rate. I get that. But again, you could retire at 60, just take more income from your portfolio. And then when Social Security hits, there's significantly less from the portfolio. You can bridge these gaps and still file for Social Security at 67 years old or 7 years old or 62. Just do not file for Social Security before full retirement age if you're still working, because you will receive a penalty because you're not supposed to keep working with W-2 income or 1099 income, basically a wage. You're not supposed to earn a wage above around $21,000, whatever it is in 2025. If you earn above that, your benefits are going to get deducted. And it just doesn't make any sense. But again, that's another one of those things that hold people back. So the big takeaways here is if you have money in a 401k, there's ways around it still to retire earlier on. Time's your most precious asset. Don't wait for Medicare. You can bridge the gap with other health insurance policies. You pay for what you get. So if you want nicer healthcare, pay for a better policy. If you want cheaper healthcare, pay for a cheaper policy. It's not rocket science. It's just understanding that you can't game the insurance game. You pay for what you get for it. And insurance is just transferring risk. They're going to win in most situations. That's how insurance works. It's not criminal. It's how it works. It's risk transference and pulling people together. And then Social Security, that's its own conversation into itself. But I think we covered it all.
Yeah, full, quote unquote, full retirement age is 67 years old, right?
For most people today.
Yeah.
It's changed over time, but for most people looking at retirement, it would be 67 years old.
And that's because they would get the most benefit or near the most benefit each month?
So it's determined when your age is, and that's just the starting point, kind of, let's say even. And if you wait a year, then you're going to get 8% bump.
Oh, okay.
If you wait 2 years, you get a 16% bump. And that bump is not compounding. It's simple compounding. It's 8%, 16%, or 24% increase of your full retirement age. That's not a compounding 8%, and then 8% again, and then 8%. Again, it's simple interest. Okay. And then if you take it earlier on, you're going to take up to a 30% hit in your benefits.
So prior to 67.
It's just kind of 67 is your starting point, and then you either take it earlier on at a deducted rate or at an increased rate.
I gotcha.
That's all the time we've got for the show today. If you enjoyed the show, consider subscribing to it wherever you get your podcast. Just search for How to Retire on Time. Discover if your portfolio is built to weather flat market cycles or if you're missing tax minimization opportunities that you may not even know exist. Explore strategies that may be able to help you lower your overall risk while potentially increasing your overall growth and lifestyle flexibility. This is not your ordinary financial analysis. Learn more about Your Wealth Analysis and what it could do for you regardless of your age, asset, or target retirement date. Go to www.yourwealthanalysis.com today to learn more and get started.